Think Smart with TMFG.
Hi, it's Mike here. Rob's away this week, so I have my special guest, Carlo Cancino.
Hi, everyone.
I was just thinking, Carlo, do you know anything about the book called The Secret?
The Secret, I think Rhonda Byrne wrote The Secret about, I think it's about being optimistic and making things happen in your life if you want them to happen.
It was a great book, yeah. It was about optimism versus pessimism and how it affects what actually happens. And it's the idea of a positive attitude can actually make positive things happen.
Right.
They always looked at the idea if you go in and you're looking for a parking spot and you envision you're going to find a parking spot, you'll generally find a parking spot right in front of the store no matter what the traffic is. If you envision that you're going to go looking for a parking spot for 2 hours, you spend 2 hours driving around looking for a parking spot. So it's the sort of the power of positive thinking. It's funny, I was thinking the other day about investors and what separates successful investors from non-successful investors. You've heard of the Dalbar studies, right?
Of course. Yes. Those are the studies, or one of the studies was where they provided you with an investment's rate of return and the investor's rate of return.
And what was the difference between them?
There was a stark difference where the investment return was better than what the investor's return was because of bad management or bad behavior.
Yeah, we always call this the client behavior. And client behavior is, or I guess investor behavior, is a big component of people's overall rates of return. It's funny because what I've been thinking is as I look at different clients and their success over the last 2 to 3 decades, I find attitude has a tremendous impact on that too. Have you ever found that with clients and how they perceive investments?
Absolutely. When I look at a client's experience, the ones that are ultra nervous and are more pessimistic about the market in general, they tend to do more poorly because they're driven by making bad decisions due to their emotion.
Yeah. The negative side of things, when people are looking for things to go wrong, it's very easy for them to find an excuse not to invest and not to put money in the market. We know the markets do better more than they do poorly. So the more time in the market, very simple equation, the more time you're in the market, generally the better rate of return you're going to have. If you take the whole idea, if you believe that you can't time markets, it's all about time in the market, right? And people with a negative attitude would prefer to spend time out of the market, which put them at a tremendous disadvantage.
Right. And I've often found when the market is being quite volatile, clients will want to make that call to get out when the market is dropping because they'll think, you know what, I'll just get back in when the market starts to recover. But what you have to understand is you have to be correct twice. So you may get lucky, be right once, get out of the market before the market drops, but then you're stuck out of the market and you're waiting to get back in. And 9 times out of 10, when the market starts dropping even further, that's the time you should be getting in, but clients don't want to do it.
Very, very tough to do. You know, even we're in 2019 this year. At the end of 2018, we saw a tremendous fall in December, one of the worst falls I've seen a month. It just free fell through December. And the first 3 months this year have been one of the best quarters. I forget, I've read all the different stats, but it's in many years, it's one of the best first quarters we've had in many years. And it'd be very hard to give you a reason ahead of time why that happened. You know, there was a lot of doom and gloom going on in December. And if you listened and read all the naysayers and the articles, it'd be very easy to pull your money in December. And you find that really goes for people with a pessimistic approach to the markets. They will listen to all that news and jump on top of it and give you a million reasons to rationalize making a poor decision and pulling out of the marketplace.
Right. I was actually just speaking with a client earlier this week, and he came out of the market relatively early before the big drop. So it was probably mid-October. There was a big drop in early October, came out in October and missed the remaining drop from November to the end of the month, to the end of the year, I should say. But now he's sitting in cash. I met with this client last week and he's still sitting in cash and asking, when's the best time to get in? And I thought, you know what? I have no idea. Right now is the best time to get in. Even though the market has rebounded, you've missed that initial recovery, but your time horizon is still long. Right now is a low point 10 years from now. So if you were to get in now, you're still getting in at a low point.
Yeah, it's tough to tell people the truth because when they ask that question, when's the best time to get in? Well, the best time was January 1st. Unfortunately, we don't have the option of a time machine. We can't go back and do that. So when you go and look at it, you definitely have to be in the market. The other thing you find too is people with positive attitudes do tremendously well. So when you find people who are always looking for opportunity, they always feel the market's going to grow. As soon as they have money, they're dumping it in the markets. They don't really care about what's going on in the news. I have clients that come in and with great attitudes, and they always just say, the economy's going to grow. It has for the last 100 years. And whether I miss out on a month's growth or 2 months' growth or wherever it sits in there, I know the next 10 years to 20 years, I'm going to be better having this money in the market. And they go to grab the money out of cash, and they get excited on bad news because they think, oh, this is great.
Right.
I have an opportunity here.
Yeah.
And they go and take advantage of that opportunity. And when you find people do that consistently over a lifetime of investments, their returns can be very, very strong. I mean, you look at the returns on S&P 500 over the last 100 years, most of them will approach
Between 9 and 10%.
Yeah.
And that's what we're talking about the Dalbar study. If the index is providing 9 or 10%, I think everybody would be happy. If they could find an investment that was going to pay on average over the long term 9 and 10%, they'd be invested in it. But why, after the Dalbar study, do you see investors' returns 4% less? It's because of that negativity. So Mike was talking about the positive thinkers. Even when the market's dropping, the positive thinkers are waiting for that recovery. We know that the economy will come back. We know that the market will come back. So why am I getting out of the market? And that's why they'll have a rate of return that's closer to what the investment rate of return is.
Greed is torture in the marketplace.
Absolutely.
And we find that when people go in, and that greed is around, I hate to get philosophical in this, but greedy people tend to be more pessimistic. They're out to take advantage of the poor. You find the optimistic people are out there trying to take advantage of the positives in life.
Right.
And that's where you come back to that whole secret where you want to really be positive on life. If you do that, it ends up paying off in the long run.
Yeah.
Well, this is Mike and Carlo, and we will talk to you and see you in the office soon.
Great. Thanks for having me, Mike.
Bye.
You have been listening to the McClellan Financial Group of Asante Capital Management Limited. Asante Capital Management Limited is a member of the Canadian Investor Protection Fund and Investment Industry Regulatory Organization of Canada. Insurance products and services are provided through Asante Estate and Insurance Services Incorporated. This material is provided for general information and is subject to change without notice. Every effort has been made to compile this material from reliable sources, however, no warranty can be made as to its accuracy or completeness. Before acting on any of the above, please make sure to see a professional advisor for individual financial advice based on your personal circumstances.